Good afternoon, everybody. I hope you guys are doing okay. We're working on wrapping up chapter 8 today. And the nice thing I like about the questions like 8-20 is that it kind of is a review of all the things that we've been doing. And since the final is cumulative, it kind of serves as a reminder of some of the transactions that we've gone through in the past. If you have any questions as we go through, please let me know. Type it in the chat, but I'll try to check and make sure periodically that I answer any questions. Okay. So August 1st, purchased 1,500 caps. I'm assuming these are hats at $6.40 on account. So just want to do the math on that. 6.4 times 1,500 is 9,600. Now this says FOB destination, which essentially means it's not their obligation until they receive it. But having read through all of the other transactions, we have to assume that it comes in sometime in August. So what we have, let me just do something here real quick. Bold that. I don't want to make it too big. If you have any trouble seeing it, please let me know. And we end up with 9,600. So 9,600 inventory and 9,600 accounts payable. Okay. Now we're moving on to the next transaction. Collected 11,400 of accounts receivable. So this must be from July and earlier sales. My little songstress is in the window. No, Zozo. No. You get down. Get down. You don't get to be a grouch. All right. And that's in our cash account. And it's going to reduce our accounts receivable by 11,400. So we got that one. Paid $900 for 3-month insurance policy beginning August 1st. So we have $900 going out of cash and $900 in prepaid insurance. Okay. So now one of the mistakes I made in not reading the question carefully in first class was that these transactions, the first 5, are all done on the 1st of the month. And since this is what we're focusing on for chapter 8, I wanted to point out here that this is going to affect your shares outstanding and your beginning shares. And effectively here, your beginning is going to be the same as your ending because everything was done on August 1st. So we have sold 8,000 shares of 50-cent par common stock for $20,000 cash. And then this just tells us about the previous shares that were issued when the company began. So what I'd like you to do now is type in chat how I should record the 8,000 shares of par or 50-cent par common stock issued for 20,000 cash. So get your feedback at this point. So those two are correct, Adam. You just need to balance it out. Keely, check your figures again. Emma, that's close. Just remember that this stock has a par value. Good job, Evan. Give you another minute there and then we'll jump in. Remember here, I'm not grading you on your attempts, so you should try. Doesn't hurt. Not retained earnings. Okay. So let's take it piece by piece. 8,000 shares of 50-cent par value common stock. So we have 8,000. You can see the common stock is included in contributed capital, but we should know that times 0.5 par value. And so that equals $4,000 common stock. And they sold for $20,000 cash. So it's going to increase our cash by 20,000. So we have to figure out, okay, where does the balance go? And that answer is whatever's remaining versus the par value. You take the 20,000 proceeds minus the $4,000 for common stock, and you get $16,000 in additional paid in capital for common stock. Okay. So we've finished with number 4. Tim's Tams paid back $1,000 to buy back 400 of the 12,000 shares issued in January. So we have $1,000 in cash that's being reduced. And then within contributed capital, we have $1,000 in treasury stock. I have a question in the chat. The 16,000, somebody asked, is the 16,000 of additional paid in capital added or subtracted? And it is added. So the only thing that is deducted that we're talking about in our basic transactions here from contributed capital would be our treasury stock. That's a contra equity account. All right, good question. So we record that. All right, paid 6,985 of its accounts payable. So we have a decrease in cash of 6,985. And we have a decrease in accounts payable of 6,985. So you can see that wipes out the previous accounts payable amount. Moving on to number 7. So during August, they sold 1,400 caps at $10 each on account. So let's take each part of this question separately. They have 1,400 times 10. And so that equals 14,000 in accounts receivable. Cap, I'm assuming baseball cap here, but maybe it's a pipe cap or something like that. Somebody asked the question, what are caps here? And it's just a inventory product. All right. So $14,000 in accounts receivable and $14,000 in revenue or sales. And then we have to record our cost of goods sold now. And it says it uses a FIFO perpetual inventory system, and that the 200 caps in beginning inventory were at $6.35 each. So for cost of goods sold, we have 200 times 6.35, which we know from up above is 1,270, and that's going to reduce our inventory. And then the remaining 1,200 comes from our purchase in number one. And so that was 6.4. And so let's multiply that out. And that equals 7,680. So we add those two. And we end up with 8,950. Cost of goods sold. I can spell that out. I got enough room here. Okay. So any questions on the first 7 transactions? Okay. Number 8, declared and paid a 10 cents dividend per share cash dividend to all shares outstanding. So I'm going to make the calculation up here, and we had shares outstanding. The 12,000 first issue plus 8,000 August 1 minus the 400 treasury, and that was on August 1. And so that leaves us with 19,600 shares out. We're going to multiply that by 0.1, and that equals 1960. So our cash is reduced by 1,960, and our retained earnings is reduced by 1,960 dividends. Number 9. Just going to scroll down just a little bit here. August 31st, made the monthly payment of $1,000 on 6% installment note. And it says round interest expense to the nearest dollar. So to calculate the interest expense, we're going to take principal times rate times time, which is principal from up here, our note payable balance, 10,678 times 0.06, the 6%. And this is for 1 month, so times 1/12. And that equals 53.4, or rounded to 53. So somebody asked where the 10,678 comes from. In our liabilities column, this is we're making a payment on our note payable. So that's right there. Okay. So we're going to have a $1,000 reduction in cash. We're going to have a reduction in our liability. It's 1,000 minus what we're paying in interest, which is equal to 947, right? I believe. And that's in our note payable. And then we'll have the $53 in interest expense. Okay. So we've done number 9. Now I have to move on to number 10. Wrote off $300 accounts receivable because a customer went bankrupt and is unable to pay for the sale made to him in July. So we have $300 accounts receivable. And what we see from the next sentence is that we're actually making estimates for uncollectible accounts. So this isn't a case where we haven't reserved for it, and we can also confirm that because we have the accounts receivable allowance there as well. So in this case, we're going to reduce our accounts receivable directly to remove that amount owed, and we're going to increase the allowance for accounts receivable by the same 300. So the transaction has no effect on our income statement. Now we're going to record our estimate for August. And one of the things I wasn't careful about is that it says 600 of accounts receivable is estimated to be uncollectible. So what they're saying is, based on the ending balance in accounts receivable, 600 of it is expected to be uncollectible. So what we have to do is use our formula, beginning balance plus our bad debt expense minus what we wrote off equals our ending balance. And in this case, we have to convert it around because we're trying to find our ending balance. So we have our beginning balance. Bold that. So beginning balance minus our write-offs minus our ending balance will give us our bad debt expense. And our beginning balance from up here is 500. And remember, that's a negative. And then we have to reduce it by a negative 300. And then subtract out the 600, and we end up with 400 bad debts expense. Okay. So we have 400 allowance, and then 400 bad debts expense. Found that all of the office supplies have been used. And so typically we take our beginning balance plus our purchased minus our ending balance, and that would give us what's been used. Our beginning balance in office supplies was 100. We don't have any purchases, and our ending balance is 0. And so what we've used is 100. So we have to reduce our supplies by 100. And we have supplies expense of 100. All right, I have a question in the chat. Why is it minus 400? That's our bad debts expense. And so our bad debts expense is a negative. So it reduces the balance. I know algebraically I didn't set it up very well, but essentially what you're doing is taking the 500 and the difference between the 500 and the 900, and it's 400, and because it's an expense, it's negative. Okay, so any questions on 8 through 12? Appreciate that last question. Thank you. All right, I'm going to move to number 13. So from number 3, insurance was 900 for 3 months. So 1 month equals 900 divided by 3, which equals 300 per month. And so our prepaid insurance is going to go down by 300. And we're going to have $300 insurance expense. All right, so just had a question. So before I finish wrapping that one up, someone asked about number 7 and where I got the 1,200 from. And sure, so if we go back, it says that we sold 1,400 caps. And they had 200 in beginning inventory. So the 1,200 is the difference between those two. And so the 1,200 has to come out of this 1,500 that we purchased on August 1st. Hopefully I answered that question. And then we're all done with number 13. And then for 14, it says recorded 1 month straight line depreciation on the truck that has a 6-year useful life and no salvage value. So remember, straight line depreciation is equal to historical cost minus salvage value divided by the useful life. And so our historical cost is 18,000, salvage value is 0, and our useful life is 6. So that tells us our depreciation is 3,000 per year, which we have to multiply by 1/12 for 1 month. And that's equal to $250. So we have $250 added to our accumulated depreciation and $250 in depreciation expense. Okay, so any questions on recording the transactions so far? Okay. So now what I'm going to do is I'm going to insert a page break here and then scroll down. And what I'd like you to do is come up with a net income and earnings per share and type it into the chat. So there's a question about, do I add both the first expense for the insurance and the adjustment in row 13? Remember that the initial purchase, there's no expense. So we're looking to the retained earnings column here for our information. And the only thing in retained earnings that we're going to exclude is dividends. Evan, you're good on your net income. Check your EPS again. Nick, you're good on your income. You're off on your EPS. Emma, you're correct on your net income. Adam, you're off on yours. You're like Colorado, Rocky Mountain High. So the shares are their weighted average. There's a question about, are the shares the beginning balance? So you should be using a weighted average. But in this case, our shares were the same for the whole month because all of our transactions occurred on August 1st. So the beginning balance would be the number that you used with the transactions that occurred on August 1st. If those transactions had occurred later in the month, you'd have to do a daily weighted average. You're a little bit Colorado too, Robert, on your net income. Give it another minute. Should be trying these transactions. Oh, really close, Natalie, on the EPS. Good job on the net income. So those of you that are calculating your EPS, tell me what you're using for shares outstanding. Type in what you're using. I just want to know what you're using. Maria, that's a good number. For net income. Okay, give about another minute, see if anybody else is going to put an answer in there. I got to save something to my drive here real quick. My dog's got like a 3-layer hair, and so my wife takes a while when she gives him a haircut. And so he got his first Corona cut yesterday, and it's pretty hysterical. So waiting for a few more answers to come through. I was supposed to go out to everybody. Sorry, Emma, I didn't mean to send that to you alone. I was supposed to go out to everybody. Okay, so I think everybody that's going to put in an answer has entered one. So let's go through. Most of you were able to get the net income. There were a few that seemed to not take out the full cost of goods sold. So let's see how it goes. All right, so your revenue or sales, so we're matching it with what's happening in this document here. All you got to do is put in your information here. So we have 14,000, and that came from transaction number 7. And then we have our cost of goods sold, and 8950. Oh, missed a 0 there. And that's also in transaction 7. So the difference 5050, that's just our gross margin calculation. And then our insurance expense, 300, and that comes from number 13. And then we have depreciation expense, and that's 250, and that comes from number 14. And then our supplies expense, 100, and that comes from number 12. Our bad debts expense, 400, and that came out of number 11. And so our operating income, the 5,050 minus the 1,050, and so that's 4,000 operating income. Number 9, interest expense is 53, and we reported that in number 9. It just happens to be. And so our net income was 3,947. Good job if you got that one. Any questions to this point? Okay, so now we're going to do number 11 and earnings per share. So our formula would be net income divided by our weighted average shares, just common stock. And so that equals 3,947. And we're going to divide it by our 19,600 shares outstanding. And we calculated that from numbers 4 and 5. And that ends up being, 0.20. All right, any questions on 1 through 11? Where did the 19,600 come from? All right, so we have beginning balance of common stock shares was 12,000. We issued 8,000, and that was in transaction 4. And then we repurchased for treasury stock 400. And that was in transaction number 5. And so we end up with 12,000 plus 8,000 minus 400. And that equals the 19,600. So dividends are not part. Somebody asked why dividends are not subtracted. Dividends reduce retained earnings, but they're not part of the income statement because they are transactions with ownership. So we would see those on our statement of shareholders' equity. Any other questions? Okay, the other parts are fairly straightforward. You can work on them for practice. So I had another question that said, why is it 400, not 1,000? In part 5, there was $1,000 is what the cost was to purchase those shares back, but there were 400 shares. Any other questions? So part C and part D, the answers are available. I believe they pop tomorrow, and you can do those for practice. Don't forget to do your coursework in Pearson. And if there are no other questions, you guys are free to go. Thank you and have a safe weekend.